It's the long stretch right now, Dr. Osama. Thanks for sticking with us through the end of the afternoon. It's a pleasure to see everyone. I've been at the event a couple of years now, and just kudos to the organizers. It's a fantastic event. They do a great job annually here. So as they kindly introduced, I'm a late-stage investor. So what does that mean? I'm generally looking at businesses kind of $50 to $500 million of revenue. As we make investments, I've been doing kind of the same old thing for the last almost 15 years now. But I'm here today, listening to a lot of the sessions. You guys have heard from some fantastic CEOs and investors who have really given great advice about startups and kind of how they scale through time. I actually wanted to back solve a little bit and share a little bit about some late-stage growth businesses that I've had the privilege of being close to over time. And what are some things that they're doing right that you should kind of imitate in your business potentially? Kind of trying to do a little back solving, which we all probably did in high school math. So 3 philosophical points I think I wanted to share with you guys today. The first is the point of contrarianism. And I think it's a really valuable lesson. So imagine a 2x2 matrix where on one axis you're either right or wrong, and on the other axis you're contrarian or you're with consensus. So what does that mean? There's really 4 options that happen. I think this is great for investing, for running your business, for life, for marriage, for all sorts of things. And so in box 1, you're consensus and you're right. What does that mean? You've kind of gone with the flow. You've gone with the herd mentality, and the herd was right. What does that mean? If you're an investor, you've made a little bit of money. If you're an operator, you're successful. Something good has happened. But you haven't had a crazy outcome, a crazy positive outcome. Let's say you're consensus and you're wrong. What happens then? You've gone with the crowd. The crowd was wrong. As an investor, you probably haven't lost all your money. You've lost a little bit. And as a business, you've also, business isn't dead, but, you've had some issues. Now let's talk about contrarianism. If you're against the flow, but you're wrong, you kind of look stupid, right? Things haven't gone very well. Your business probably has gone flat on its face. But if you're right, that's what investors look for. That's what, great operators look for. And I think it's important because, a lot of the crowd here today is from the Middle East, South Asia, Asia, a lot of similar cultures. And the concept of saving face is really important. And so the last thing a lot of people want to do is fall flat on their face, have, their teta or their aunts or uncles, talking about them, about how, someone started a business and how it completely failed. And so I think a lot of folks don't push themselves in a way to be contrarian and right, which is a very rare thing to do. At my old fund, we were investors in Netflix for basically the last 20 years. Jay still has press clippings of every analyst who said every decision that Netflix made was stupid. And for a number of times, those decisions everybody was pretty unanimous that, hey, going this DVD by mail strategy is silly, the streaming strategy is silly, et cetera. Airbnb, the concept, one of our old investments, the concept of renting out your second bedroom to a stranger, making money off that, and then on the flip side, strangers staying in strangers' apartments and actually paying. I mean, that sounds stupid, but it's a great business. So I think first piece of advice, think about your life decisions, think about your business. Where are you contrarian and where are you not? And don't be wrong, but don't be afraid to be wrong. That's kind of point 1. I think point 2, the concept of learning to adapt over time. You may think, hey, thanks, you're telling me to adapt as my business kind of grows up over time. That's not really novel advice. But a couple kind of stories out of that. There's a business that a lot of folks here know called Zillow. A business I've had the pleasure of investing in, getting to know the management team intimately. For those who don't know, basically 75% of all U.S. Real estate searches start and end on Zillow.com. It's a $10 billion company today, really built kind of over the last decade, so not a lot of time to create so much value. There's two stories, I think, that come out of there that really kind of hit at this adapting point, because I think that's really the difference between great and even good businesses. The first is with their pricing strategy or their revenue model. A lot of folks just look at them today and we're like, hey, if I were around 15 years ago and I had the concept of a real estate internet marketplace, things would be good, and I would have built a $10 billion business. A lot of things look good in the end, but a lot of us, a lot of folks, as you look at these businesses over time, you don't appreciate how hard certain, I don't want to say pivot because it sounds a little cheesy, but these important inflection points in businesses are. Let's imagine, so for Zillow's case, for example, let's imagine kind of you three folks are real estate agents. And their initial model was you've got 50% of the San Francisco market, you've got 30%, you've got 20%. And every single ad request that comes in the San Francisco area, half of them will go to the first agent, 30% to the second, 20% to the third. Pretty nice. High margin, growing nicely, and they went public off of that. Now let's imagine a world one day where your traffic going to the site is growing much faster than the revenue generated by the business. Why is that? That's because the business is working, and so a lot of people are going to the site, but we're charging these people a fixed fee. So our revenue isn't growing as fast as they are. And this one product that we've got is 95% of our business. And oh, by the way, all of our executives, most of their comp is in equity, it's in stock, and it's a one-product company for the most part at that point. What happens? Do you adjust? Do you basically change the engine as the car is going 70 miles an hour down the highway? What's incredible about that team, as I've gotten to know them, is they've frankly had the stomach to do that 6 times. 4 to 6 times, somewhere up there. And every time they made one of these changes, their stock went down 30, 40%. The street freaked out. They're like, these guys are blowing up our business, and the stock went down. But they had the perseverance, the conviction to do this, and obviously it's worked out for them. The second example is a business a lot of you may know, which is Opendoor, and as it relates to Zillow. Opendoor basically legitimized house flipping. Completely opposite business model. Capital intensive, balance sheet intensive, you're buying houses and flipping them, you're not getting the cash back for a period of time. Imagine a profitable internet company like Zillow seeing a startup like this come up and kind of laugh at them initially, being like, hey, this doesn't work. But as they saw that model get traction, they decided one day to completely redo their business, and today it's called Zillow 2.0 in many ways, and go full force into that business. The street rewarded them by cutting their $9 billion market cap in half. There are a lot of folks here in the audience that will work at startups or are investors and imagine your 409A, your stock options. I mean, I've seen people where it's it drops 5% and they're like, oh my God, I got to go to the next business and get out of here. This thing's going to fall apart over a couple cents change. Imagine your stock every day is now down. One day you wake up, it's down 50%. How do you, as a management team, how do you manage your people, keep them focused, and have full faith, have their faith in you that you made the right decision? But they did it. Stock's back up, and off they go again. So I think the lesson there is, there are pivots. I'm not talking about pivots here. This is, they're still in the same business. They're making changes along the way, but these changes, as the companies get bigger, get harder. The constituents get affected more. And so I think the difference between great and good businesses, a lot of times, are the people that can make those changes. The last point I kind of want to mention on this, which is kind of more of a personal point, organizations take on the personality of their leader. And so if you're the CEO of your company, if you run a division, a lot of folks don't notice, but your employees embody a lot of times your personality. If you're overly aggressive, if you're very aggressive in sales, your org is going to be very aggressive. If you're cutting corners, your org is going to cut corners. And it's remarkable how it's almost like, it's like a little family or something like that. But as we encounter these businesses, $200, $300, $400 million of revenue, and we meet, the CEO and spend time with him or her, it's amazing how an organization really embodies that person. So it's something to think about for the founders in this room. Your actions really get read by your employees pretty deeply. So I say 3 very different points, right? Learning to adapt, some management stuff, and the concept of contrarianism. How do we tie all that together? There's 2 things as a growth investor when I meet a business, I'm looking for, and obviously we're looking for P&Ls and financials and all that sort of boring accounting stuff. But to put it into 2 short stories, I think the first is we are forward-looking, we're not backward-looking. What does that mean? The best investors I've ever met in my career, I could swear to you, it's almost like they don't have a rear-view mirror in their car. It's like they just don't look backwards. It's a lot of auto drivers drive that way. So they don't look backwards. They just, you just go straight. So what does that mean again? So if your company is growing 50, 60, 70%, a lot of you may even see this in the stock market. You see, your favorite stock report earnings, they crush the quarter, earnings are up, revenue's up, expenses are down, everything is good, but they lower their forecast of future growth, the stock gets hammered. Why? Because everyone's paying you for what you will do in the future. Maybe it's unfair, but that's the way a lot of growth in tech companies work. And the past, is really just a way that we use to judge if you're full of crap or not, as you tell us what you're going to do in the future. It's less indicative of what you'll do. It's just how we understand who knows what they're doing and knows what they're saying or not. I think that's the first point. The second point, which also sounds a little fuzzy, is know who you are as a company. We're all Valley, we're in the Valley, a lot of Valley folks here. There's the common phrase of the best product will win, which is true in some segments. It's almost like religion, in the Valley. But I can point to dozens of businesses where the best litigators will win, the best sales and marketing people will win, even if they don't have a real tech product, the best corp dev, M&A team will win. There's a lot of examples of non-tech product driven businesses that will still succeed in their certain areas. I think what we, though, look for is when we meet with someone, do they know who they are? Do they say, hey, we're product tech driven, because that's kind of the buzzy things to say. We've got AI, we've got all these different things. But then you spend time with them and you're like, actually, it's a sales and marketing company. And either they're kind of BSing us or they don't really know who they are. And so some of the most impressive ones know what their strengths are, and they double down on those and focus on those. So those are just a couple quick anecdotes of kind of things we look for, hopefully helpful. I think we got 2 minutes, so can answer kind of anything in that world that's helpful for folks. Thank you. Yes, May. Yeah, good question. So a couple of things. So just for folks who didn't hear, Trey right before was talking about competitive markets and kind of how they view them. And the question was kind of how does SoftBank view competitive markets? How do we invest in them, et cetera? I think 2 things. Maybe to differentiate, because our strategy on the software side, so I help lead a lot of our focus on the enterprise software segment, and consumer are very different. Consumer, and part of the reason for that is because primary capital, dollars in a business, can be used in very different ways in those 2 sectors. On the consumer side, you can give someone big pile, bags of cash and tell them, hey, go spend it. Either in Google, TV, et cetera, go acquire customers. And if we think you have the best product with your big piles of cash, you should be able to acquire the next marginal customer better than the next person. Once you have all the customers, theoretically, the best product kind of wins over time. And that's working and not working in certain areas on the consumer side. On the enterprise side, it's a little bit different because piles of cash actually don't make a huge impact to software companies because you've got to go hire. The more money I give you, the more people you have to hire, which drags your efficiency, your burn rate, your efficiency, your markets, all that sort of stuff. And so what we focus on is who are the leaders in particular segments, and how can we help them more than the next person? Meaning, Japan is the second biggest software market in the world, which a lot of people don't realize. So how do we take them to Japan? How do we take them to Latin America? How do we sell them into our portfolio better than anyone else in the market? My first investment, we as SoftBank have added over $20 million of revenue to them through Japan, our portfolio, Latin America. That's a huge, I've not done that across every investment I've made combined times a multiple. So that's just a little bit kind of how we think about it. I think we have time for one more quick question. Or we're good? Oh.
You mentioned something about adapting.
Yeah.
You also mentioned that you have to know yourself. So does it mean adapting, changing yourself, or does it mean really just staying fidel to your nature, but adjusting
Yeah.
your story a little bit?
Really good question.
How much do we adapt?
Let's start. It's a really good question. How much do companies adapt over time? I think the first thing to focus on is the knowing yourself. And what do I mean? I don't mean this to be a psychology session for folks, but what does that mean? To me, that means I'm shocked at how many businesses I meet that are generating 75, 100, 200 million dollars of revenue, and we do diligence on the business. We spend time with the business, and we learn more drivers of their business than the management team knows. That's pretty frequent. It happens a lot of the time. And so the first thing I'd encourage business, and I think, to be honest, we're 12 years into a bull market. We're 12 years into this up market. I think a lot of companies have gotten a little lazy with details in this market because 6 years ago, you couldn't raise from 30 people who are just willing to throw money in term sheets without any diligence. That's the market we're in today. So I think companies have gotten a little lazy on that point. So the first piece of advice is, as opposed to focusing on the next competitor or the next fill in the blank, turn all your diligence weapons internally, understand what are the drivers of your business, what makes you great, what are your levers for success. Once you do that and you have those, you have that understanding, I think the data, actually 95% of the data is actually pretty clear. It tells you what to do. It tells you what you're good at. It tells you where you should focus. But I think a lot of people actually don't listen to the data because, hey, I've got my co-founder who I love, who's been running this division for 10 years, and the division sucks. The data says that, but I really don't want to do it. It's these emotional things that don't allow people to, really act in the right way for their own business. So hopefully that answers a little bit of kind of what you were getting at. All right? Cool. Time's up. Thanks, guys.